Options can also be used while exercising capital budgeting process. In this process, two types of issues can be encountered by the analyst, like the shareholders of a given firm may prefer a project with low NPV over the project with higher NPV. Similarly, the shareholders might even go for the projects with negative NPV over the projects with higher positive NPV. Now, to understand these issues, let's take two different examples. In example 1, we have the market value of assets to the tune of 20 million. The firm has pure discount debt with the face value of 40 million with the maturity of 5 years. The assets standard deviations return is 50% and the risk free rate is 4%. Now, using these values, we can determine the market value of equity and debt. The market value of equity is 5.744 million, whereas the market value of debt is 14.256 million. This means that this is a highly levered firm with the leverage ratio of 2.48. Due to this reason, the option is out of money, and as a result, the firm's delta is 0.547. Now, let's see that the firm is considering two mutually exclusive projects, Project A and Project B. If the firm considers these two projects, let's see the effects of these projects on the firms. The market value of equity of the firm in Project A is $5.895 million, and for Project B, it is $8.751 million. For debt, the market value for Project A is 18.035, whereas for Project B, it is 13.249 million. So, the total market value of the assets of firm in Project A is $24 million, and for Project B, it is $22 million, and that is in fact the sum of 20 million earlier value of the assets and the NPV of the individual project. So the NPV of Project A is $4 million, and for Project 2 it is $2 million, whereas the standard deviation on the firm's assets return is 40% for Project A, which is down by 10%, and for Project B it is 60%, which is up by 10%. And if we see the impact of Project A is that both the shareholders and the bondholders are gaining, but bondholders are gaining relatively greater than the shareholders. For Project B, the equity gainers are gaining more than the debt holders. So we can say that clearly the shareholders of the firm will go for Project B. The implication of these two projects is that we see that when equity having the delta much less than 1, the value created by the firm will go to the bondholders. This means that there is a strong incentives for the firm's owners to increase the leverage or the volatility on the firm's assets return. Now let's see the example 2. We have a market value of assets of the firm to the tune of 20 million. Now, in contrary to the earlier example, we have pure discount debt to the value of $100 million with the debt maturity of 5 years, and the standard deviation of rate of return of the firm is 50% with the risk-free rate of return is 4%. Using these values, we can again calculate the market value of equity and debt, and the market value of equity is $2.012 million, whereas the market value of debt of the firm is $17.988 million. Again, the firm is a highly levered firm with a leverage ratio of 8.94. In this case, the option is far out of money because the resulting delta is 0.24, and as a result most of the value created by the firms will go to the debt holders. This means that the firm has now firm has only one project to consider. And if we see the effect of this project on the firm's balance sheet, let's see, the equity of the firm has market value $4.334 million, and the market value of debt of this firm is now $14.166. Therefore, the total market value of the assets of the firm is equal to $19 million, which is equal to the $20 million of the earlier market value of the firm's assets and a negative NPV of $1 million. The return on assets with the standard deviation of this firm is 70%, which is again much higher, and the impact on equity is greater than the double, because earlier the market value of equity was just over 2, whereas now the market value of the equity is $4.87 million. Now, what implications we can draw from these analysis? We see that there is a strong incentive for the owner of the firm to increase volatility on the return on the firm's assets, because now the owners have relatively little amount to use because of likelihood of becoming the bankrupt in the firm. And due to this reason, there is a strong incentive for the shareholders to go for a long short position, even if that long short has a negative NPV, as we have seen in this example.